So this week we're talking about the foreign direct investment, and on Monday and Wednesday we talked about how or why the host country would welcome the foreign direct investment into their country, and what would be some of the reasons why they wouldn't want it. They wouldn't want the foreign direct investment in their country. We said that the host countries appreciate FDI because they bring money, they create income, they bring or build infrastructure. They do pay local taxes, payroll taxes, sales taxes, and they bring tax income. They bring technology, not just through their contribution with their own existing technology, but we talked about the case of Tesla, where Arizona required Tesla to donate $20 million to the local university. So they bring technology development to the area. We also said that the FDIs have a tendency to train and educate their workforce, and therefore it improves the intellectual and academic capability of the host countries. FDIs bring in competition, and competition makes the local companies better, and FDIs also bring international integration, which again, I think that for emerging countries and developing nations and underdeveloped nations, this is one of the most important aspects of foreign direct investment. And then we talked about some of the issues why they wouldn't want to have foreign direct investment in their country. And again, we talk about how FDI brings in competition, and competition can kill the local businesses, and therefore it could lead to a monopoly. We talked about the example of Walmart in Vermont, state of Vermont. We talked about how Walmart is not welcome in certain countries because they're too small, and Walmart is too big. For some countries, Walmart's total revenue is probably bigger than their GDPs, and they simply cannot compete. So it leads to monopoly. So the competition in this sense may not be as welcome as, for instance, in auto manufacturing or banking. We said that the FDI can be influential. They can actually change labor laws, environmental laws, and they can exert influence to make things not necessarily better for the country, but better for themselves. We said that FDI can be politically involved with respect to safety, national security. We talked about how, in the case of Iran, if they wanted to have an FDI in a country to pursue, nuclear, power, because of the U.S. embargo on Iran on nuclear power, this might actually be a problem for the host country. FDIs have a tendency to, seek out natural resources in countries, and we talked about how FDIs are usually involved in mining and oil and refining and piping, and therefore these may become an issue. In fact, the case analysis that we assigned for this week is an example of this natural resource, how the country first wanted to have the FDI, but then after the elections, the government changed, and the new government, more nationalist, they didn't want the FDI, and it was a whole mess. It was over a decade ago, but it's nice to look at it from a future perspective. Now that we know what happened, it is now more 2020 hindsight. And then we talked about how FDI may have historical, cultural issues, religious issues, colonization issues, issues with imperialistic motivations. We talked about how China's influence in Africa, financial influence in Africa recently has been cited as a concern for the Western allies, and how in the case of, say, United Kingdom, they might actually have issues with investments back and forth with older colonies, and these may actually become sensitive issues, political issues for the host countries, and they may not be willing to allow FDI for these concerns. And obviously, FDI can have negative impact on international integration as well. It depends on the company, it depends on the type, but it also can alienate certain countries based on the acceptance of certain FDIs. So today, we were talking about why would the corporations want to invest or not invest in FDI, right? And I mean, this, sounds a little bit easier than, talking about the host countries. I guess the main, reason that everybody would say the first would be, cheap labor. So let's put that out there and get it over with, right? So one of the main reasons why corporations want to have an FDI is they're after cheaper labor. Um, and it's very easy. That's it. So perhaps easy environmental laws, and that's also very easy. And now let's get a little bit more creative. From a corporation perspective, logistics also plays a significant part. If you think about it, for a company, say in Europe, who wants to export products to China or vice versa, there are a couple of ways they can actually arrange transportation. They could go around the world and then reach China, which would be really long, or they could go underneath and then that would be really long. And then, or they could go railroad, that would be costly, slow, and not that short. So if you think about it, it's actually not that easy. And they also have to go through certain countries that may not be as cheap or as easy to access or transit through. So from a logistics perspective, it may be in the best interest of European nations to, if they're going to be exporting to China, they may actually be looking to FDI and invest in some other countries who are either closer to China or perhaps just produce in China to access the Chinese markets. So logistics, right? And notice at the end I said access to Chinese markets. So the idea behind an FDI is you want access to certain markets, right? Like for instance, if Volkswagen wants to sell, or Mercedes or BMW, they want to sell in the US, and what they can do is they produce in Germany or in Europe, and then they can ship the cars over here. And but they actually have certain downsides to it. Well, first of all, it's more expensive, and two, from a consumer perspective, I think there's a huge difference between a car that's, the Hyundai has these TV commercials that says "Made in Detroit," and I think that goes a long way. We look at them as they're invested in this country, and therefore, not a domestic production, but not as foreign as those cars that are totally imported. And therefore, we look at these perhaps a little bit more friendly compared to 100% import cars. And for several products, I think the access to markets play a significant role. I mean, um, we talked about the natural resources right here, and so perhaps we should also talk about it now. Access to natural resources. So perhaps we could talk about these two together. I mean, certain developed nations have more consumption power. They actually have more money. GDP per capita is higher. So if you are a retail company or a producer in a country where the GDP per capita is low or lower, it may be in your best interest to seek to export to countries where you can sell. However, like I said, export can be costly. It can be long way out. It can be not as friendly perceived in the country, and therefore having an FDI in the country might actually have significant difference. What might actually make significant difference. So the access to natural resources is very self-explanatory. If you think about it, if you are an oil company, you might actually have to do an FDI simply because you have to go to the oil rather than, if you're an oil company out of, say, Louisiana, there's so much oil in Louisiana that you can do. It's all pretty tapped out. Now you are looking for an FDI because you have to. You're an oil company. You need oil. You have to go to the oil. Or, mining companies for gold or for precious stones, precious metals. or even for iron, steel, copper, silver, you have to go to the natural resource at the site. So you need to do FDI. Perhaps I need to add another one right here: access to financial markets. Um, you need to issue a bond, you need to issue a stock, but as a foreign company, you may not be as um, well received. So, it may be easier for you to have a presence in the country in which you're going to issue a bond or issue a stock, and therefore it allows you to borrow in the markets where borrowing cost is cheaper. Um, so access to markets, perhaps I should say access to retail markets, but it also would mean that access to labor markets, access to, um, you know, retail markets, but then also access to financial markets. And I think that access to markets, access to financial markets are a significant portion of the reason why corporations consider FDI. But also think that logistics is, I think, one of the major issues. Or perhaps I should say all of these are very important. So they also are looking for international diversification. And we talked about this a little bit when we were talking about the foreign exchange diversification and hedging. And the idea, oops, sorry, misspelled it. And the idea is if you are a company like, say, Toyota, and you have sales in multiple countries, if you only produce in one country, then your production will be in one currency, and then your sales will be in multiple currencies, and you're exposed to currency exposure, foreign exchange risk exposure. So it will be much easier to produce in one country and sell in that country to simply diversify yourself enough that you wouldn't have to take that foreign exchange risk. So perhaps I could say foreign exchange. And like I said, it's very simple, simply because for a company who produces in one currency, sells in another currency, creates a significant problem. For a bank, deposits in one currency, credits in another currency, creates a significant problem. So, say for Deutsche Bank, who wants to get into the mortgage market in the US, you're talking about US dollar credits. But if your deposits are only in euros, then your deposits are in euros, your mortgages are in US dollars, and you have a foreign exchange risk. It would be much easier to have a bank in the US as an FDI, collect deposits in US dollars, and then lend mortgages in US dollars to eliminate that foreign exchange risk. Obviously, international diversification can also come in political, and I want to say etc. Political risk, military risk, I mean, you name it. But we recently seen this in the case of Russia. When Russia had a military conflict with Ukraine, many of the companies who had an FDI in Russia had to pull out or chose to pull out. And that's an example of the diversification. If you're a company only invested in Russia and you have to pull out, then you would have a significant problem, because that would be all your eggs in one basket. But if you had FDI in multiple countries, then it's just one of your markets and you're not as susceptible. So, and also for companies who are domestic and domestic only, you're exposed to the risk of your domestic nation, the political risk, the economic risk. So maybe I should say political, economic, financial, etc. So you're exposed to the political, economic, and financial and other risks specific to your country. I can extend this list more. A couple of decades ago, we had a earthquake in Japan, and that almost literally crippled the entire island's production. And if you're a company of 100% domestic production, then your operations simply stopped. So unless you had international FDI where you could produce, you had to close shop for the duration of recovery. So all of this is, it is a significant issue. So for corporations, so we said the cheap labor, well, I don't want to say easy, but I want to say favorable. And then logistics, and access to markets, financial markets. So maybe I should just say retail markets. Natural resources, diversification, and international collaboration, right? And this goes into, partnerships, subsidiaries, affiliates, and, especially on the research and development side, we are looking to, create or have access to capabilities of other, perhaps more developed nations or similarly developed nations, and having um, a partnership in these countries could have significant positive effect for our companies. So one of the ways of doing this, obviously, is having an FDI in another country with partnership. So, for instance, when the first factory that Tesla bought was a factory that they bought that used to belong to Ford and Toyota, if I'm correct, but one Japanese, one American company. So they actually had a factory together, and this is not very uncommon. You can actually have even competing companies operate a common manufacturing facility, simply because if they need a certain part, if they need a certain production to be made, it is in their both interests to produce that as efficiently as mass production as possible. And therefore, Toyota couldn't accomplish this unless they had an FDI in the US. And then, for other countries as well, if individual countries have their own competitive advantage with an FDI, with a partnership in the country, it might be much easier to tap into these markets, and it might be just in their interest to work with collaboration in these areas. So, what will be some of the reasons why corporations wouldn't want to have an FDI, right? So, this is not as clear cut as why they would want it. So if they don't want it, you stay domestic, right? So, within the domestic market, they can actually exert monopolistic power. So it doesn't mean, obviously, that, the FDI would be ruled out by them. But, with complete focus in their domestic market, they might actually become more of a monopoly in their own country because they have the 100% focus in that country. Um, they may have political influence by becoming a single country corporation. They might be more, did I spell that right? Let's see if I'm going to get, they might actually become more nationalistic. They might try to reach out to their consumers with more patriotic flavors, if you will, and therefore, rather than going out internationally through FDIs, they might sell their single country investments as more nationalistic, and therefore they might try to have a little more political influence on their audience. And for companies also, staying domestic, they might actually have subsidies. Governments can provide companies for incentives if they stay domestic. One of the great examples of this is Apple. Apple almost exclusively produces outside of the US. There's one product they actually produce in the US, and I think it's because they had to cave into the pressures of the US government. They produce these high-end desktop PCs I think, in Arizona, and these are very expensive PCs, and I don't think that they produce all that much anyways. But I'm not sure if Apple is getting any subsidies because of this. However, it was a political pressure, and they have to produce in the US. So in that case, for that product, Apple chose to stay domestic rather than doing an FDI or going through a supplier internationally. The corporations might also have um, domestic protection. So, I mean, maybe this is under the subsidies a little bit, but if a company stays domestic and domestic only, they might actually, um, and this is really not that easy, but they might actually try to eliminate some of the international risk. Um, but like I said, the first week of the semester, we talked about how every company is international. Even if you're talking about, say, a shrimp farmer out of Louisiana, you're talking about an international pressure simply because even in the state of Louisiana, we import shrimp. I mean, it's sad, but it is what it is. So even a shrimp farmer in Louisiana is competing with imported shrimp. So, by not going FDI, perhaps companies can have a little bit of a local protection. But like I said, even a shrimp farmer is competing internationally. That's not exactly how, they would have, isolation. Nothing is in a vacuum anymore. But I guess in our textbook it mentions that domestic production comes in different flavors, and therefore perhaps the idea behind this is that by staying local, you eliminate some of the international risks that you're exposed to that we listed up, like political, economic, and financial risks that you try to diversify. By staying local, you only take your risk and not other countries' risk. So today, this is all about it actually. Like I said, for the countries, I think it's a little bit of a bigger deal, but for corporations, the reasons of why they want it is um, perhaps a lot clearer than why they wouldn't want it. Companies have everything to gain from an FDI, especially through their international collaboration, their access to markets, and environmental or say favorable laws. And access to research, access to partnerships. And so from a corporate perspective, it is a much more viable option to, to do foreign direct investment and then not doing it, right? So for corporations who are capable of doing this, I think that we also see them as multinational corporations, and their structure is a little bit more stable financially compared to single nation corporations. So that's about it for today. If you have any questions, please do let me know. And I really do appreciate you guys working with me. Hope to see you soon. And I hope all goes well. And thank you. Have a great day.